I think I'm going to exit the June-July dated purely because I'm becoming a little bit more tentative about how I want to position in the future. So I think a better expression will be long June-July DFL roll. Hi, welcome back to another episode of Trading Corner. So we have to talk about fuel, right? I think the whole market is kind of whispering about it. You know, even crude traders are like, what is going on with the fuel cracks at the minute?
Yeah.
So maybe we'll just get straight into it. What are you thinking?
Well, yeah, it's quite amazing. So you've got positive high-sulfur fuel cracks in Europe.
All-time highs, right?
I'd need to double check, but
Yeah, I think that's what our fuel trader said. All-time highs on the cracks.
So pretty amazing, and like particularly given we should be in peak refinery runs, so we've got very strong CDU margins, and which the fuel oil crack's contributing to, and it's basically saying run your CDU flat out to pretty much every refinery.
Yeah.
So yeah, it's quite an amazing position to be in, and I'm a bit surprised. I guess there was quite a constructive sentiment this summer, but I think even that was surprising. To the upside.
I think what's quite interesting is it's so localized on the curve to kind of June-July spread. So I know obviously when you have this like huge crack move, especially in either naphtha or fuel, the kind of waste products of the margin, there obviously tends to be a lot of volatility as well. You have refiners coming in rushing to hedge. As soon as those waste barrels become flat or slightly positive, the impact to the margin is crazy, right? It's real money you're adding back.
I guess what we may be seeing is that just like the long-term trend is for refineries to produce less and less high-sulfur fuel oil. Mm-hmm. So there's been globally like an overbuild. What it feels like we've had an overbuild of upgrading capacity. So there's probably too much coking capacity relative to the amount of fuel oils that are being produced. So I think we're in a scenario where actually maybe that many refineries aren't left who produce fuel oil to kind of come out and hedge that. Because I don't feel like we've had a load of like kind of hedging to sell it.
Exactly. I guess what's quite interesting is because even if you look at how this month is pricing, it's doing okay. But given we, typically are in a slightly shorter product environment for May than we are in June, as you said, refinery output starting to increase, we're getting higher run rates, etc. It's quite interesting that the month that looks the tightest for fuel is June. So yeah, some of it might be, as you just mentioned, the refiners are just too complex for the high sulfur fuel market. But it does seem as though, let's see when we get actually into
I think also
pricing.
Temperatures, so like demand must be decent. So power demand in the Middle East should be super high on the weather. So that's obviously contributing to it.
And also, if you look at like kind of the global infrastructure of the refineries, I think China specifically has had, relative to all the other refineries, one of the lower run rates. And they are arguably some of the older refineries out there, right? So potentially produce a bit more high sulfur fuel. But I think it was last month, their refinery utilization relative to kind of the last 3 to 5 years is around 10% lower. So I think they're currently producing around 60% refinery utilization, which for this time of year is fairly low, I would say. So that might also have a knock-on effect. But it is quite interesting how the curve has been allowed to move, and also the impacts on the east-west. So, typically a lot of this strength came from Singapore, right, or the east. Now, you're going to get all the cargoes facing Singapore. So now we're feeling that tightness also hit Europe. So yeah, it'll be interesting. I've got a lot of people asking, what's going on there, but it's just, as we just said, it's a classic situation of there's just the physical is just not there, right? So it's a bit of a perfect storm, but the implications on the margins are quite interesting. So yeah, it's very specific, as you said. This is where the refinery economics is actually going to come into play, because people look at these margins or these cracks and they're like, wow,
I think the question
really,
would
really
just
supportive.
is how relevant is a margin with a load of high sulfur fuel oil now?
Yeah. So what % of a margin do we think has high sulfur fuel?
I think it's probably pretty low now. So
Yeah.
like just the general trend in Europe is that simple refineries have been closing over time. So the simple refineries, the average refinery has become more complex, and so the yield of high sulfur fuel oil
Yeah.
has fallen, and a lot of refineries, even the simple ones, have shifted over to try and make 0.5 fuel oil. So I think that's what we're seeing now is refineries have managed to shift production to 0.5.
Yeah.
And they're not producing that much high sulfur.
And these two, the 0.5 versus 3.5, it's not that interchangeable, right? Well, it must not be, otherwise.
It's not, although I think high sulfur has got so high, it's got to the point where it's potentially going to pull some marginal streams that might have gone into 0.5 towards the high sulfur. I mean, high sulfur is still at a decent discount, so like there's probably not that much that moves through, but from what I've heard, potentially some intermediate streams might be starting to move the other way.
Okay. So let's see. I mean, again, we'll have this lead lag effect, but it seems as though that strength isn't going anywhere for now.
As you said, so the tightest moment's now, and the market's pricing that will loosen a bit as we go into the summer, when normally you actually probably hit peak tightness in kind of Q3. So I think it's potentially, I think the summer should be moderately constructive, although I mean, it's so high and it's very hard to be short. So anyone who was short has kind of been taken out. So you could maybe argue we're potentially in an overbought area. So I think if we do start to see any physical weakness, I think there's quite a bit of room to the downside.
Exactly. I guess the only thing is when it comes to a situation where you've got genuinely a tight physical market, and we also go into pricing, sometimes we've seen it in Crude a lot of times, if no one can sell these cargoes, that spread could go to the moon. There's no reason why.
Without a doubt, yeah. And arguably maybe that's what we're seeing in the June contract. Is the front spreads, the Balmo spreads super high.
Yeah. Anyway, it'll be an interesting time for sure. I think though, the market's kind of looking at where these ARB fixtures are going to move as well. I think, some of the fuel coming out of kind of North America or like Mexico, etc. It's looking where to point to. Either Europe now that the east-west is starting to soften, or still into the east. Obviously, temperature is a big one that moves the high sulfur fuel market at this time of year. So weather is a big thing, right? If we get any kind of cool weather helping in Southeast Asia or, any other part of Asia, to be honest, especially kind of the Middle East. But we'll keep an eye out for the temperatures there. Other than that, I mean, we just got to just see what the market's appetite is. If we do get these cargoes coming out, as you said, there could be some downside.
Yeah, and I think it's interesting, as you mentioned earlier, like the Dubai pricing. I think most people would, including myself, would have thought if fuel oil was so strong, that might have fed through into Dubai, particularly like positive fuel oil cracks, and given so much of Dubai is fuel oil. So it's quite amazing.
It is amazing. I think so. To just quickly talk about, the crude impact from a high sulfur fuel environment. We're seeing it in Europe. It's playing out exactly as you would expect. So Johan Sverdrup is a crude, it's more sour, typically produces a bit more fuel oil than any of the other dated grades. That has definitely rallied. So I think probably about 2-3 months ago, it's trading at a $2 discount to dated. It's currently being bid around a 1.85 premium to dated. So you can see that kind of
massive.
That $3 swing that's come from fuel has gone almost exactly into those premiums in Johan Sverdrup. So Europe, as you would expect. The interesting thing about Dubai is, and it's been a big contention actually for the last couple of months, is the fact that Murban is in the Dubai benchmark. And currently what's happening is the cargoes that are converging in the east, in the Dubai benchmark, is Murban. And Murban's actually light sweet. It's not that sour. So how kind of high sulfur fuel producing is it really? I don't think that much. I think it's very much a middle distillate producing barrel. So that's arguably why we're not seeing it in Dubai. But the other grades, the typical Al Shaheen, Upper Zakum, etc., Oman, they are more sour, heavier sour, but they're just not being delivered into Dubai right now. So there's been a big contention because there was some kind of with the way the methodology is created for Platts, there was a bit of an issue. I mean, you can read the officials to see Jorge's commentary on this a little bit better. But essentially, it was discounting Merben a little bit too much for a light sweet. But what can you do? It's the way that, the mechanics of the window and the physical markets, etc. It's how they play out. So until that is resolved, I think it potentially won't be reflected in Dubai. Which is why we've also seen Brent Dubai rallying quite a lot, because the thing that's setting the Dubai benchmark, Merben, nobody really wants. So it'll be quite interesting. You can see it in the curve, and I think it is a big worry for the market. But you're exactly right. A year ago, maybe 2 years ago, when Merben wasn't, I think it was about 2-3 years ago, when Merben wasn't in the benchmark, yeah, Dubai would have exploded for sure. Just off the knock-on fuel, of course. So yeah, it's not quite playing out to that mechanism at the minute, until Merben maybe prices out and other grades start setting the benchmark. But definitely quite an interesting, you really need to know about how the Dubai mechanism and how the cargoes are put into the benchmark works to really know why it's not moving up as much as you think.
Well, maybe as you mentioned, like Chinese runs, if Chinese runs are lower, could be feeding in. It's just the lack of demand.
Yeah, I think that, but also, you can't deny this fuel move, why it wouldn't impact Dubai. And that's the only thing I can think of. I mean, let's see, maybe
just the incremental OPEC barrels and like lack of China runs, but
yeah, I think it is a few things, but
agreed. It's still super perplexing given the
it has to be something physical that's going on there, given these fuel cracks. And I think they were discussing potentially putting some kind of quality premium onto Merben to help, sort out this problem, which should allow the Dubai benchmark to move up. But it's very much just in talks right now. Let's see if it actually happens.
Yeah, because the CDU margin on Dubai must look extremely high.
Exactly. So yeah, super interesting time. Let's see if these changes to the benchmark happen, but it does seem as though they are necessary. Okay, so aside from fuel, how's everything else? How's the light space?
Probably on the products, it's actually been a bit boring since over the past couple of weeks. So I think naphtha maybe has come off a bit. Gasoline, like I don't think it's moved. Maybe it's bounced around a tiny bit.
Yeah.
Distillate has maybe softened a touch, but it's not really done anything. So I think the kind of the rock star has been fuel
for sure. Okay, and crude really similar. We've kind of flatlined. It does seem as though people are fairly bullish for June, July. So we're seeing a lot of kind of prompt June buying, prompt July buying. It's all helping this June, July contract to perform. So that's really.
So you're right on your spread view.
So far, we've gained about 30 cents, I think, from the last time we spoke about it. I don't see that going anywhere for now. I think generally kind of June and July tend to perform pretty well for crude. So I think we're probably going to be in that same...
And should be supported from the margins. So like margins are extremely good.
Exactly. And we are hearing rumours of kind of a little bit more strength in the Atlantic basin. Refinery run rates in the Gulf Coast should be improving. So that will, again, help keep those cargoes local in the US rather than being arbed over. But yeah, for now, I think we're kind of in a point of equilibrium. I don't really see us, going to the moon or like equally rating, although we do have OPEC coming up this weekend. And it does feel like the market, again, thinks that they are going to increase production. To what extent that's actually priced in already, I don't know. But generally, I would say that there's probably downside risk to flat price, upside tail risk to dated Brent. So we're going to be playing the kind of physical premiums versus the futures, I think. I think that's the right way around for now. So yeah, that's it really. Maybe we can just jump straight into the trades.
Yeah,
I mean, there's not much to really comment on.
From my side, not much change to the general view. So refinery runs, margins are good. Refineries have come back from maintenance. So runs should be high, should be fairly supportive of crude. And I mean, I would have thought it'd be fairly bearish straight on products. Maybe we're seeing that in naphtha. We've not seen it in fuel oil, but for my trade view, I'm sticking with my long deferred, so long Dec 26 EBOB cracks. So I think, I've I liked it from just below 3. I think it got up to about 350 and it's had a bit of a pullback to around like 320. So I'm just still holding that trade. If it got back to 3, I'd probably look to increase. And yeah, if it moved higher, I'd maybe take a bit of profit, but basically keeping a hold recommendation.
Okay. And for me, I think I'm going to exit the June, July dated purely because I'm becoming a little bit more tentative about how I want to position in the future. So I think a better expression will be long June, July DFL roll. And another one I'm going to go long is probably Q3 DFL. That was previously a data to buy, and I'm just going to convert that into a regular DFL. The reason for that actually, and I just really quickly want to talk about it, is kind of the ARB contracts, the data to buy, TI Brent, they're all getting actually quite expensive. And it's fine for now because freight is starting to soften. But if we are going to get local strength in the North Sea, any of the kind of marginal barrels that usually head over to the east will need a lower data to buy environment. So in order to force that, we're either going to need to see the Dubai benchmark pick up or data to come off. And seeing as though I think we are in a stronger crude environment, I see it more in the Dubai benchmark picking up a little bit. So for that reason, I'm just going to convert the Q3 data to buy into a DFL.
Cool.
Cool. We'll see you in a couple of weeks how it left. Thanks.